Good evening. Good evening and welcome to the class. This class is sponsored and taught by Silicon Valley Score, siliconvalley.score.org. Score, by the way, offers free consulting, additional classes, and other assistance in creating your business. As a matter of fact, I've been with Score as their client for 3 years now, and I really enjoy. On top of that, I have at least 8 to 10 different score mentors. It really helped me to really navigate and guide my business for the next 3 or 5 years because of the expertise of everyone. At the same time, they also connect you with other resource people that are expert on the industry of human resource, marketing, operations, IT, and even accounting. That's why if you think you need their expertise, please call them at their number at 408-453-6237 or visit their website. I will be your speaker for today. Last week, we talked about the payroll tax deferral. Today, November 10, we will talk about what is the employee retention credit versus the family first tax credits. I'm the CEO and a business owner, tax professional, IRS certified acceptance agent. Through our continuous contribution to the business community through pre-webinars and seminars, we have been recognized as the Business of the Year by the SBA. And for today, I will be your score subject matter expert. Let's all dive in. What is employee retention versus family tax credit? There you go. Just a disclaimer that this presentation or materials are intended to provide general information and guidance on the subject concerned. Examples and other materials in this webinar are only for illustrative purpose and should not be relied upon for technical answers. Score and the speakers take no responsibility for any errors or omissions in or for the loss of incurred by individuals or companies due to the use of the materials of this webinar. The webinar will last 30 minutes. If you guys have any questions, feel free to chat on the Ask a Question box below. All questions will be answered at the end of the presentation. Don't worry if you miss the beginning, the session is being recorded and recording link will be emailed to all participants. Let's dive into this. I'm Christopher. Now, we have a hypothetical client. For example, since my experience with dealing with clients, this is a very common situation that the client has employee and they got sick. So our business owner is Gloria. She's 45 years old, a single mom and owner of a restaurant running the business since 2014. However, our year 2020, we have the COVID-19 situation. One of her employee experienced symptoms of COVID-19, whereas the other employee also needs to take care of the kids since the daycare is closed. The question, is there any available IRS payroll credits she can use? Or my question to you guys, are you experiencing the same situation? Let's find out. What is new? There are two COVID-19 legislations that give generous tax incentives for employers through payroll tax and business losses. The first one is what you call the very popular, the CARES Act, because they care for you. That is the Coronavirus Aid, Relief, and Economic Security Act that was signed on March 27 this year. It was a supplement of the FFCRA, which means the Family First Coronavirus Response Act, that was signed March 18, 2020. To make it simple and easy to understand, always remember that CARES Act is employer focused. The FFCRA, it is family focused. That's to make it easier. We provided a table. All you have to do when you are looking on the right side, it says ERC. This is under the CARES Act. The EFMLA and the paid sick leave credit are under the FFCRA. Christopher, what is EFMLA? Oh my God, there's a long acronym from CARES Act, FFCRA. The EFMLA is Emergency Family Medical Leave Expanded Act Credit. The main difference of this one, like what I've said, the FFCRA are employee focused when they get sick. So in the case of Gloria, let's say her employee, let's say the employee is the cook Christian. If Christian got sick, or even not even him, but his member of the family household, it does not need to be a family member. It can be just a household member that lives in the same house. He can actually use, Christian can use the paid sick leave or the EFMLA credit. Now, the only limitation is the number of employee. You are, it is only limited to fewer 500 employees. On the other hand, the ERC, it is not limited to 500 employees. But the problem about the ERC, if you apply for the PPP, okay, just take note, if you apply for the PPP, you cannot, again, you cannot apply for the ERC. Moving forward, the type of employer, of course, everything is eligible, but I would like you guys to focus on the type of credit. This where is the difference. For the paid sick leave under the FFCRA, the paid sick leave and EFMLA, the self-employed, like what is self-employed? People that work on their own, they don't have employees and they got sick. The good news is you are also qualified under the self-employment tax credit. The same thing with the EFMLA credit. However, for the employee retention credit, this is for the payroll. Okay, just because self-employed, they don't have employees, they work on their own, but there's a chance whether like let's say Gloria does not have any employees, she's considered as self-employed. Therefore, she can qualify for the self-employment tax under the FFCRA credit. The effective date. The effective date, of course, the ERC, the CARES Act, was implemented on March and it's valid until December 31. However, the FFCRA comes on April 1. It is valid from April 1 till December 31. But Christopher, what is the difference of the paid sick leave versus the EFMLA? Remember, it's the number or the duration of days. When you are sick, let's say on the case of Christian as the cook for Gloria, if Christian is sick for 10 days, he can use the paid sick leave credit. But if it goes beyond that, let's say Christian gets well, but he has to take care of his son that doesn't have a daycare, then he can use the expanded family medical leave credit. Okay, so that's why the computation is very different. For the first 10 days, Christian is sick, he is given the maximum amount of 511 per day up to 10 days. So that is equivalent to 5,110. But don't you worry, we provided a table later on for you guys to know that it is much easier to understand with the table. But after the 10th day, then the payment will be cut into what? $200 per day, only for the purpose that Christian needs to take care of his son. He will be given up to 10 weeks. That is $200 per day for the next 10 weeks. That is multiplied to what? 50 days. So 200 times 50 days, that will equivalent to $10,000. Then he has another $2,000 there. Therefore, the total credit, refundable credit, will be amount to $12,000. However, on the other hand, the employee retention credit, it has no basis whether the employees are sick or whether their family members or household member is sick. It is based on the order for the COVID-19 suspension of the business. So therefore, if the sales of the company of the restaurant of Gloria went down more than 50%, he can actually she can actually cut the hours of her employee. But in return, she will be given a 5,000, maximum of 5,000 in actual credit for qualified wages. All right, so just a reminder, this employee retention credit has nothing to do with any sickness regarding COVID-19. This is where the table. Christopher, what are the reasons to be given by using the FFCRA or the Paid Leave Act? The reasons are 6 actually. For the first 1, 2, 3, this is if the employee is under a federal or state or local quarantine or isolation order. So if Christian was experiencing symptoms and has been advised, number two, has been advised by a healthcare provider to self-quarantine, then number three, experiencing symptoms of COVID-19 and seeking a medical diagnosis. But the question, okay, does my employee needs to have experience 1 to 3? The answer is no. Only one of the reasons he could qualify, Gloria can send home Christian and apply for this credit. The computation a while ago that I'm mentioning, this is the table. This is what you call the sick leave. All right. So from reason 1 to 3, your employee, okay, so the maximum is $511 per day. For example, Christian as a cook, he's receiving $10 per hour. He has up to 10 days of leave because there's 40-hour work week in a week times 2, that would be what? 80 hours. So $10 times 80 hours. Therefore, the refundable tax credit would be $800 for Christian. Okay. Now, but how about if self-employed? Okay, so for example, Gloria is self-employed. Where is the basis of the credit, the paid leave credit? It will be based on the ADSEI, or what you call the average daily self-employment income. The computation is like this. They will base it on the last year, 2019 gross income, for example, $150,000. Then after the gross income, there are business expenses. The net income is $100,000 for 2019. What's going to happen? It will be divided to 260 days. Why? Because Saturday and Sunday are not included. So it's like 5 working week. There are 260 days working week in a year. So therefore, the ADSI, the net income will be divided 100,000 divided by 260 days. Then the ADSEI, or the average daily self-employment income, would be 385 per day. Did he exceed the limit? No, because remember, the maximum amount per day is 511. Therefore, he still qualified for the $385 per day. Okay, but just remember this number because we will go over on the next reason for how to compute it for reason 456. The 456, this is what I referring a while ago, that if Christian, his son, that is subject to a federal, state, or local quarantine are also in isolation, or he has to care for a child, if the school or place of care of the child has been closed, it does not necessarily mean that the son of Christian need to be sick. No, if it's just the school or the daycare center is closed and nobody is going to take care of the child. And number 6 reason is employee experiencing any other substantially similar condition. It could be a flu-like symptom. Then what is the computation? For reason 4 to 6, the employee or business owner will be given $200 per day for the next 10 days. That would be 80 hours. But wait, there is a kicker. He's not going to receive the full amount, the $10 on the actual computation. If Christian is receiving $10 per hour, only 2/3 of that will be given to him because he's not the one that gets sick. 2/3 of $10 will be $6.67 per hour times 80. Therefore, Christian will receive for the next 10 days of $534. But for example, after 11th day until the 10th week, that will be on the 50th day that he will be absent from work because he has to take care of his child. What's going to happen? This will continue for the next 50 days. That's why we came out with the 2,000 and additional 10,000 using the Expanded Family Medical Leave Act. For the business owner, it's also not going to be the same. Remember, I mentioned about that Gloria has an ADSI of 385. If it's going to be more than 10 days, 11, on the reason of number 5, until on the next 50 days, it will be also cut in 2/3 or 67% of 385. That will be $257. But my question, did she exceed the threshold? The answer is yes, because according to the regulation or legislation, it's only maximum of $200 per day. Therefore, Gloria will not receive 257, but rather only $200 for the next 50 days. There you go. There's so much computations, there's so much legislation. So that's why as early as now, you have to contact your score to get to know more about this information. Christopher, which form do I have to use? This is what you call the form 941 for 2020. I always suggest when you're using your QuickBooks online or desktop, they always have this update button. You just have to always update the form. If you don't have the accounting software, all you have to do is go to the IRS. Make sure you type Form 941 IRS. Make sure to put the word IRS. Why? Because there are so many companies that are third party that they provide this, but you have to pay. Don't pay because this is free. All you have to do is download the 941 PDF, IRS. That is a copy. You can download it and you can compute. They added the line 5A and 5A1 and 5A2, the qualified sick leave wages and family leave wages. I don't advise that you compute it manually because there's a lot of computations here. It's better you use an accounting software or go ahead and contact your score mentor. All right. Then here on 13C, they added this new line. I already highlighted this. The refundable portion of credit for qualified sick and family leave wages will be added here. And the refunded portion of employee retention credit will be added here. But okay, on our next slide, always remember there is no double dipping for credits, which means to say you are only allowed to use one or the other, not together on the same payroll wage. Okay? The IRS has ensured that there is no double dipping for credits. Consequently, employers who take this credit on certain wages cannot take the credit on those wages for paid family medical leave under section of the Internal Revenue Code. Additionally, an employee included even the work opportunity tax credit under section 51 of the Internal Revenue Code may not be included for purposes of the employee retention credit. Business owners taking these other credits should evaluate which credit is more advantageous to them. So that is the summary for our the employee retention credit versus the family first, so the FFCRA. There's so much abbreviations. Now, on our next presentation by next week, if Gloria, she already used this. What other else that she had? On this case, she obtained $100,000 of PPP on the second quarter of 2020. The question is, since we're talking about taxation, and this is the best time because we are almost ending the year, November, December, will she be taxed on this PPP loan? Therefore, you have to stay tuned next week. That would be next November 17th, taxation of forgiveness of Paycheck Protection Program loans. Yes, we are going to have Thanksgiving. Time is so fast. I hope you guys learned something today, and all you have to do, please download, go to these resources for you to find the full article. The final word, while these tax incentives are designed for employers to increase their access to cash, it is still subject to limitations and regulations. That's why SCORE can help. Make an appointment with SCORE consultants today or visit their website. Thank you for attending the class. If you have any issues with our class or SCORE, please email workshop@svscore.org. We'd also like your help by writing an online review of our class. You can do this at Yelp_of Silicon Valley. The website or the link is provided below. Today again, I'm your presenter, Chris Waikoko, business owner, tax professional, IRS certified acceptance agent. Just one of the most common question, what is a certified acceptance agent? This is for people that have don't have social security, but they would like to apply for a business. So enable for them to file and register a business, they need to have an individual tax ID number. The normal process at this point with the IRS is you have to submit all the original documents, either your passport from another country, your birth certificate from another country, that was implemented many years ago to avoid or prevent the cases of fraud. But now, nobody would like, and I mean, nobody would like to submit these original documents. That's why we have an IRS certified acceptance agent. So basically, either virtually or or physical location, we could actually certify the document without sending the original to the IRS. That is the role of a certified acceptance agent. Okay, thank you guys. I hope you learned something for today, and we will go if there are no more questions. Thank you. We have 8 participants or 7, or thank you for listening. If this is the time that we will open our webinar for any questions. You can unmute yourself, but if you don't want to talk, you're always feel free to chat. Well, I guess everybody absorbed everything what I said. No, you guys are welcome to watch the replay.
You do have one question, Chris, from
Yes.
Kalar.
Mhm.
Is the employee retention credit applied in the tax return?
The employee retention credit, that's a very good question. If you are self-employed, the form that you are going to use, you can claim the ERC by using your filing 1040 by next year. It's under your 2019 1040 return. You have to put there based if you made an income like you already identify because the credit is how much up to 5,000, right? So if you have, you could only use it using a 1040 for filing your 2020 tax return to get the credit. That's a good question. Is there anything else we have?
You
Okay.
got a, you
There's
got a
there.
great big thank you on that.